Good morning. The webinar will begin in 2 minutes. Good morning and welcome. On behalf of the ASA Women in Industry Division, we would like to thank you for joining us to discuss personal finance strategies. Many people start a portfolio without professional advice. They don't coordinate their goals and don't know how to stay on track. We've invited Glynnis and Jean from AXA Advisors to share tools for success. Throughout the webinar, you will be muted automatically, but we do invite you to type in questions into the appropriate questions section of your GoToWebinar control panel. With that, I'd like to pass it over to Glynnis.
Great. Thank you, Jessica. Welcome, everybody. I'm so glad that you took the time to join this call. So I'm Glynnis Reinhardt, and I'll get it right out of the way because you're going to spend the next 45 minutes wondering where my accent is from. I am from South Africa, and on the call with me today is Jean. Jean is my co-worker at AXA, and he is going to be monitoring all the questions so that we can, hopefully by the end of this presentation, answer all the questions you may have. I'm thrilled that Jean asked me to be the presenter today because I'm going to tell you a little story about myself and why talking to a group like this is really exciting for me. So 20 years ago, I was a physical therapist. And I wouldn't have known a mutual fund if it hit me in the face. And I was getting very upset with family law in the United States because I'd had a sister go through an ugly divorce and a couple of friends go through divorces that just didn't work out very well. And so I single-handedly was going to go back to law school and change family law in the United States. And so 20 years ago, I sat down with my family at Thanksgiving, and I have two brother-in-laws and a sister-in-law who are all lawyers. And I told them I was going to be studying for the LSATs and going back to law school, and they all burst out laughing. They said that it was the worst idea that they had ever heard and that I would make a terrible lawyer. So I was very offended, and wounded, but I gave it some thought, and they were probably right. And so after lots more soul searching, I decided that the best thing for me to do was to try and get involved in women in finance before the bad things happened, because I came to realize that a lot of the reason why these women in my life had really gotten the short end of the stick in their divorces was because they had been incredibly naive and uninformed about the personal finances in their lives and in their lives with their spouses. For example, my one friend, her husband was cheating on her, which is not ideal, right? But the worst thing about it all is he was paying for his girlfriend's kids to go to a private school in Arizona and writing checks right out of the family checkbook. And my friend didn't have a clue. She had her fancy car, and her husband was very successful. So she had a nice car and credit cards and a nice fancy house, and had absolutely no idea how much her husband was earning, what the mortgage was, what their payments were, what was going in and out of the checkbook. So while he was certainly not behaving in an ethical, decent way, she was so naive. And so what I came to realize is that I wanted to be this person who educated women and explained and empowered them so that they would be in a better situation, whatever happened down the road in their lives. What I also came to realize is that not only do the men need our help, the women need our help, but the men need it too. Because men do a very good job of pretending they know what they're doing. And so I'm thrilled that this call was opened up to both women and men, so that hopefully at the end of this 45 minutes together, we will have been able to impart some financial wisdom and whet your appetite enough just to start your financial journey. Because you'll see from this seminar that I'm going to do, it's a very generic seminar touching on a lot of topics. Each one of them could be their own individual 1-hour seminar. So hopefully we can just get you excited enough, or at least worried enough, to start paying attention to some of the aspects that we discussed today. And as I said, please be sure to type in your questions, and Jean is monitoring those, and we'll try and get to all of your answers and questions at the end of this presentation. So we will move along, and you will look at the agenda. And as I said, it's a very basic Finance 101 presentation. Hopefully there'll be something in it for every one of you. And we're going to try and cover all of these topics in this 45 minutes. We're going to look at the advantages of smart financial management. We're going to look at all the obstacles that get in the way of you having success, and then all the components that make up financial management, and then some pointers on how to get started. So financial management really begins with that very first paycheck. And one of the things I love to do is do these types of lectures and presentations to graduating students. I do a lot of work in the university market, and when I can get in front of a group of graduating teachers or graduating nurses, I'm ecstatic, because we can have them do things right from the get-go, before they get that very first paycheck and before they even realize what it is to bring all this money home. We can have them start putting away some money before it comes back into, you know, your bank account, because when it does, it's certainly spent very easily. So really getting started right away is ideal. You want to have a goal. You want to have a roadmap. There's a saying that says, if you don't know where you're going, any road is going to get you there. And so it's really important to have that track to run on, to have a game plan, to have goals so that they can be coordinated, and you're going to be far more successful with that type of goal and program. So one of the things we're going to talk about, or in fact, we're going to talk about obstacles to financial success. And the big obstacles are you have expectations, but you don't have goals. So we all expect, for example, we're going to retire. Well, you've got to have a goal of how are you going to make that happen? Because you can't just keep working and think, oh, I'm 65, now I retire and there's going to be money there for me. You've got to have those goals. You've got to have that track. You've got to have that plan. We're going to look a little bit about what we call the kiss of debt and inflation and procrastination. And I've got some stories on procrastination for you. So let's talk about my soapbox topic, which is the kiss of debt. I hate credit card debt. It really stands in the way of so many of my clients having fiscal independence and comfort in retirement. If you have credit card debt, it should be your number one goal to retire it as soon as possible. Credit cards are so negative. Credit card debt, not credit cards. If you use your credit card and you pay your balance off in full at the end of every single month, I have no problem with a credit card. But set it up for automatic payment so that if you cannot afford to buy something and pay for it at the end of the month in full, it should not be going on that credit card, because credit card debt is evil. It really is going to cause you a lot of problems, both while you're working, because it's taking away from your discretionary income. It's taking away from money that you could save. It's taking away from money that you could spend on good things, because instead you're paying the credit card companies a very high interest rate. If you look at this example on the screen, if you had a balance of $3,000, which is not very high, you can get to $3,000 unfortunately very quickly. And a 12% interest rate is not very high as well. Many of the credit card companies are charging 14, 16, 18% interest rate. And if you miss a payment, it shoots up to 22%. It's crazy, it's robbery. And if you pay only the minimum on that credit card of $50 a month, it's going to take you almost 8 years to pay off that credit card, and the interest alone is over $1,500. So credit cards, you can see credit card debt is incredibly costly. If you have no self-control and you cannot keep that credit card in your wallet, then you need to put it in the freezer. Put it in a cup of water and freeze it. It works. I've tried it. And then if you need to use your credit card, you have to come home and defrost it and think about it. And that will hopefully take care of some of the impulse control. You have to stop charging. You want to focus on the cards with the highest interest rate. So if you have 3 or 4 credit cards, I urge you, take the ones with the highest interest rate. Some people, when I sit down with them, don't even know what interest rate they're paying on these credit cards. So find that out, take the one with the highest interest rate and start paying that off as aggressively as possible. Pay twice as much as you can of the minimum payment on that one. The minute you've paid that one off, take everything you were paying on that credit card and then apply that to the second credit card with the second highest balance until you've gotten rid of all of that credit card debt. It's going to take time for those of you with high credit card balances, maybe a couple of years, but you will feel such a sense of relief when you get those credit cards paid off. The other thing that you can look into, if you have home equity in your home, you can apply for a home equity line of credit, a HELOC. I caution you here though, I'm very reluctant to recommend this as a way of getting rid of credit card debt if we do not control and correct the behavior that got the person into credit card debt in the first place. So if you are a spender with no self-control, if you cannot change those behaviors, do not do a HELOC, because you're going to get back into the same problem a year or two later, and now you've got a home equity line of credit to pay off. and you've got credit card debt, and you're going to find yourself in a whole lot more trouble than you were before. So if the credit card debt was because of some emergency or an event that you had no control over, and now you've a medical catastrophe, for example, and you can use a HELOC to get that paid off, go right ahead and look into that. That's sometimes a very good way to retire the credit card debt. You want to establish a realistic budget. And so many of my clients who I work with who have credit card debt, we have to do a, come to Jesus moment and tighten that belt and really stick to the budget. And we'll talk about budgets in a little bit, but very often, unfortunately, there's not a lot of wiggle room in that budget. Many people are living paycheck to paycheck, and it's extremely difficult to try and find the extra money. So for those of you who have not gotten into credit card debt yet, don't go there. If you can avoid it, you're going to be far better off. And for those of you who are there, do whatever you can, make it your highest priority to get rid of it. All right, so that's my pet peeve, and I'll move on. Inflation. Inflation we call the silent killer. It's like heart disease. It really, you lose buying power in your money as we go further and further ahead. So for somebody who thinks they have a lot of money today and is retiring in 20 or 30 years' time, if that money is not growing or keeping up with inflation, you're actually losing money. So I have a client who is very fearful of the market and only wants to be in CDs. The problem with that strategy is the CDs are only earning 1-2% interest, and if inflation is at 3%, you're not growing your money enough to keep pace with inflation. So it's extremely important to have some of your money invested in the market in a way that it will keep pace with or even beat inflation, so that in 20, 30 years from now, you have buying power that has beaten inflation. Because you can see in 1913, if you had $1 to buy that McDonald's in 1913 or whatever you could buy for $1 in 1913, you needed almost $25 in 2017 for the same buying power. So inflation is something we have to be aware of when we're investing. All right, procrastination. I'm going to tell you a story about a lady named Angie. I work in Ohio in the university market, so a lot of my clients are affiliated with large universities in Ohio. And I do the benefit fair every year. And about 9 years ago, Angie came to my table at the benefit fair, and we talked about getting involved and starting with a 403B. A 403B is actually the kissing cousin of the 401k. So for those of you in industry, the 401k is the retirement plan usually offered through your employer. In the nonprofits, in schools, hospitals, universities, it's a 403B. So I was discussing with her why she should do a 403B. She was very interested, gave me her number, and I followed up with her a week later. We met. I explained, did my little finance 101 for her, and she said, yes, she definitely wanted to do it, but I should call her back in 6 months because her husband was going through a new changing jobs and she wasn't sure. So 6 months later, I followed up, and she had a different excuse, and her husband had had a machine fall on his foot, and he was out of work on disability for a few months. And then I followed up a few months later, and now she was pregnant and she wasn't sure. Well, fast forward 9 years later, every year she comes to my table. We're very good friends now. I meet her every year. She comes to the table and she says hi, and she promises me that this is the year that she's going to do her 403B. And as you can see, I met Angie when she was 25. Well, she was probably in her early 20s. So let's say Angie was 25 when I met her 9 years ago. And if she had started her 403B, in order to have $500,000 at age 65 when she wanted to retire, she would have had to put in $189 a month in order to have $500,000. Most of the money she would have put in she would have put in 90,000, and all of it would have been growth. 409,000 would have grown to 500,000. But Angie is fast approaching the 10-year mark. Next year or this year, in fact, will be 10 years when I meet her at the benefit fair in October. So she's now 35. She now has to put in $407 a month to get 500,000 at 65. And if the last 10 years is anything to go by, we're probably looking at another 10 years before she finally has a good reason to start. So at 45, she would have had to put in $954 a month to reach that same 500,000 at age 65. So what this slide is showing you is the importance of, number one, not procrastinating. Don't be like Angie. Start early, put in a little bit of money as soon as you can, and let it grow, because compound interest and time value of money are going to be your big, big friends. You can see the earlier you start, the less you have to put in, and the better you're going to be at the end of the day. So it's so important to just get started. It doesn't matter how little you put in, but I guarantee you, if you put in nothing, you will have nothing. We're not supposed to give any guarantees in our business, but that is a guarantee. Do nothing, you will have nothing. So get started as soon as possible. All right, how to get started. We're going to talk a little bit about a budget, insurance, estate plans, investments, taxes, and retirement plans. And as I said in the beginning, each one of these could be a whole hour of presentation. So I'm just going to touch on the most important of each one of them. You got to set goals. You will never, ever hit a target that you cannot see. So I want everybody to at least take out a yellow piece of paper and go home and write down what your short-term goals are, what your ongoing midterm goals are, and what your long-term goals are. And then try and put a plan together to achieve those goals. So short-term goals, for example, would be creating or updating a will, and we'll talk about wills in a little bit. Ongoing goals, trying to get rid of that credit card debt. Long-term goals, saving for college, saving for retirement. I'm going to take a minute right here and just give you my opinion, and I'm very opinionated, so I'm going to give you my opinion on saving for college. I am not a big fan of saving for college until you have done the maximum you can to save for retirement. There's something called loans for college. There are no loans for retirement. For those of you who have kids, the best gift you can give your children is to take care of yourselves and have a comfortable retirement so that your children are not worried about you in retirement. I take care of my mother. Fortunately, I'm in a financial situation where I can do that, but I never want my children to be in that position. I want you to be able to put away everything you can for your retirement so your kids don't have to worry about you. And if they need to take loans and they need to get scholarships and they need to get financial aid for college, so be it. But college education funding should be last on the list, and only do that when you have fully funded your retirement. All right, moving along. Excuse me. So let's talk about getting started. The first thing we talked about is set those goals. You're never going to achieve anything if you haven't gotten it written down, if you don't see it, and if you don't constantly come back to it to reassess. Now we'll talk about pay yourself first. I will talk to you about a gentleman I met when I first got into the business 19 years ago, who was a janitor who was the custodian at one of the elementary schools in Indiana. And his name is Ron. And Ron had the most unbelievable assets. It was incredible. This guy had never earned more than $26,000 a year in his entire life. He retired about 6 years ago, earning 26,000. He had worked for 30 years at this school, and he had 580,000 in his 403b. He had a tractor collection. He had a gun collection. He had 2 rental properties in Milan, Indiana. He was unbelievable. And I said to him, this guy had never finished high school. And I said, Ron, how did you know to do this? Because he had amassed a lot of this before I even started working with him. I took over his account 20 years ago, but he already was well on his way. And I said, how did you know to do this? And he said, honey, he called everyone honey. Honey, my mama told me, pay yourself first. I gave 10% to my retirement. I gave 10% to my church, and I blew the rest. And I've been doing that for 30 years. So Ron is a perfect example of pay yourself first. Please get started, get some money into your retirement accounts, and we will talk about the emergency fund next. I am a huge believer and really encourage you to make an emergency fund, if you don't have one already, high on your list of things to do as one of your primary goals. So getting rid of credit card debt needs to be number one as far as I'm concerned, but but emergency funds goes hand in hand with credit card debt, because most people are not in credit card debt just because they are big spenders and shoppers. Most people have credit card debt because things happened and they didn't have the money to pay for it. So you had something like grandma died and we had to get to Alabama for the funeral and we had to buy tickets last minute. Or tires blew out on your car and you need your car to get to your job. You got to pay for that. The furnace goes out in your house. You need a furnace. So those are things that require an emergency fund. I am a big fan of the online online savings accounts. So I, for example, bank with Chase Bank, but my emergency fund is with Marcus Savings Account. So I'll name a few for you. Marcus Savings is a great online savings account, 2.15% interest, no fees, no restrictions, no penalties, FDIC insured. I don't work for Marcus, but here's another one, Synchrony. Same thing, 2.15, FDIC insured, no fees, no restrictions, no penalties. Ally is another FDIC online bank. They have higher interest rate. The other reason I love the online banks for your emergency fund is they're a little bit out of sight, out of mind. So when you log into your checking account, if your savings is right there, it's too easy to get to. You just click a mouse and you can move the money between the savings and the checking and it's done. Whereas if it's at an online bank, it takes 48 hours to move the money between your checking and your savings account online. So I jokingly tell people that most things can wait 48 hours. So unless you need to post bail or you have a gambling problem or a drug problem, everything else can wait 24 to 48 hours. And I would highly recommend you open up an emergency fund on one of those online banks, and then each month move money from your checking to your emergency fund. You really want to have 6 to 8 months worth of expenses, monthly expenses in that emergency fund. It's going to take time. It's a process. It's a marathon, not a sprint. And just when you get there, then you're going to have some emergency that requires you to take money out of that account, and then you've got to build it back up. So it keeps going, but you will not find yourself in credit card debt if you have an emergency fund. So please, to reiterate, no credit card debt, and start working on your emergency funds, and then start saving for retirement as soon as possible. Those are the 3 big rules for me. Have things deducted from your paycheck. The more you can have things automated, automation, automation, automation. The more you can do that, the better you're going to be. If you think you're going to wait and see what happens at the end of the month, and if you have money left over, you're going to move it over to your savings or to your retirement, forget about it. It's not going to happen. So set it up on automatic as best as possible. And then we'll talk a little bit about company retirement plans in a few slides. So another component of good financial strategies is having good risk management. And risk management is your different types of insurance plans. I'm going to really just spend 2 minutes on this. The biggest, most important one that I want to talk about is life insurance. Life insurance, your biggest asset is your ability to produce income. And life insurance is the only thing that really is going to be able to replace that income should you die way earlier than expected. And if you have family and you have people who you're going to leave behind and who are counting on that income, the best, most unselfish gift you can leave them is life insurance. So if you have some through your employer, that's great, but it's usually not enough. The best thing to do is look at large death benefit, cheap term insurance to get you through the early years of family and children. And then in later years, you can always look at permanent life insurance more for estate planning purposes. Disability insurance, incredibly important. Studies show that 1 in 4 people today in their 20s will become disabled before reaching 67. So if you have the ability to purchase disability insurance through your employer, you definitely want to do that. There is disability insurance that's available in the open market as well, depending on your profession. Long-term care insurance, very important, but can be very expensive, and most people don't start looking at long-term care insurance until their late 50s, early 60s, because they're so busy trying to save for retirement, get kids through college, and bring up the kids and the family. So it's usually something that gets looked at later in life. And I could do a whole hour on long-term care insurance, but we don't have the time, so I'm going to move ahead and talk about estate planning strategies. That is, again, another hour-long presentation that we can do for you, but I will tell you that 54% of Americans die without a will. So one of the things that I would love to have you do as one of your short-term goals is, if you do not have a will, get a will. You can do one on one of those LegalZoom, one of the websites. I would encourage you, though, to take that once it's done and maybe just take it to a lawyer and pay them just to review the document and make sure that you have designed it in a way that has the right consequences. Because if you don't put your will together correctly, you can have a situation whereby somebody gets to receive money. And I'll tell you a quick story of a guy who, a woman and her son were involved in an accident. They got hit by an 18-wheeler. And the father of the child was the deadbeat drug addict who had never paid child support, had never been involved in the kid's life. And the mother had a will. She had done a simple will herself online. And the will said that if something happened to her, everything went to her 14-year-old son. And in the accident, the mother died at the scene of the accident, and the 14-year-old son was airlifted to the hospital, and he lived for 48 hours. He was on life support, and he eventually died. What happened by her will is all the money, there was a wrongful death settlement of a couple $100 million, I think $2 million in the wrongful death that was paid out by this trucking company. And the money would have went straight from the mother to the son, but because he died and the will only went as far as the mother then to the son, guess who got the $2 million? The deadbeat dad who had never helped or had never been part of this kid's life at all. So it's very important to make sure your will is written correctly so it doesn't have unintended consequences. Okay, so Investment strategies. Let's talk a little bit about Finance 101, because that's the part that I think is so important that all of you understand, so that you're all comfortable at least getting involved in your retirement plans and Roth IRAs, etc., through your employer. So getting started is tough. Don't procrastinate. Don't be like Angie. Don't make excuses. There will always be, it will never be a good time. So to me, the best time is now. Just get started. I'm going to run through, I'm going to skip these 2 slides, and I'm going to talk about this slide in great detail. I'm going to tell you about what I call my Finance 101. I'm going to take 5 or 10 minutes to talk about basic investing strategy and principles that MBAs do for a year at school. We're going to do it in 5 or 10 minutes, and you're going to know all the important things that you need to know. So there's 3 rules for investing: diversification, asset allocation, and dollar cost averaging. So when you invest in your employer plan or an IRA or a Roth IRA, you are going to invest in mutual funds. Mutual funds are a group of funds that are professionally managed by an outside money manager. And the advantage of being in a mutual fund versus an individual stock is you have more diversification just in the mutual fund alone. So a mutual fund will have maybe 200 or 300 different companies inside of that mutual fund that the money managers are managing. So for example, if you own the individual stock of, let's say, Lehman Brothers, right? You can wallpaper your wall with that right now because it's worth nothing. They went bankrupt. But if it was only 1/200th of your mutual fund, you didn't get hurt nearly as badly being in a mutual fund. So by its very nature, a mutual fund is diversified. But mutual funds have to be further diversified by different kinds of mutual funds. So you'll hear the term, and some of you might be familiar with these terms, some may not. But if somebody said to you, I'm in a large cap mutual fund. A large cap mutual fund is a mutual fund that consists of big companies the size of P&G, GE, Microsoft, or Apple. So large cap mutual funds have many, many companies, but they're all big companies. So we want to diversify our mutual funds even further by having different size mutual funds. So there's another term that says, I'm in a mid-cap mutual fund. That's going to be a mutual fund that has companies the size of Cintas, which is a medium-sized company, not as big as a P&G or a GE, but still a large company out there. And then you'll have small cap mutual funds, which would be your .coms, your startups. If you haven't heard of the company, it's very often a small cap. Bob Evans would be a good example of a small cap mutual fund. And then you're going to have international and global funds. Those are mutual funds that have companies outside of the US. Then you'll also have mutual funds that are bond mutual funds. So they don't have stock or equity companies in them, but they have bonds inside of their mutual funds. So you have high yield bonds, municipal bonds, global bonds, all different types of industry bonds in your bond portfolios. And then you'll have things like money markets, CDs, guaranteed fixed accounts. So what does diversification mean? In simple English, do not put all your eggs in one basket. So when you invest in your 401k or your 403b or your IRA or your Roth, you want to make sure that you have money spread across all the different asset classes. You want large cap, mid cap, small cap, international, some bonds, maybe some safety. Now, how do we decide what percentage we put in each of those buckets? That's called asset allocation. And that's going to be based on 2 things. It's going to be based on your risk tolerance, your appetite for risk, how much you can tolerate the ups and downs in the market. And it's also going to be based on your time frame. So the longer you have to invest, the more aggressive you can afford to be. But there are some people who are young who just can't tolerate the volatility and the ups and downs in the market, and they tend to be more conservative. So when you meet with your financial person, somebody who's helping you set up your 401k or your Roth IRA, they're going to do a risk analysis with you, and then going to decide if you're a moderate, maybe you're going to have most of your money in the middle buckets, with some in international and maybe a little in some in conservative. If you're aggressive, you're going to have everything towards the large cap and the international and the small cap, and you're going to have almost nothing in the bonds and the fixed. So that's called asset allocation. So we want to be well diversified. We want to have a good asset allocation. And the final rule of investing is called dollar cost averaging. And for all of you who are already doing something each month in your employer sponsored retirement plan, you're doing dollar cost averaging without even knowing it. What dollar cost averaging is putting money into your retirement plan or your investment every single month, irrespective of the market, because we cannot time the market. We never know what the market's going to do. If I knew what the market was going to do, I promise you I would not be on this call. I would be retired in Costa Rica, and we would not have this call today. So we don't know what the market's going to do. So we have to put money in the market every single month. When the market is high, our money will buy less shares. When the market is low, because it's doing poorly, our money goes into the market, we buy more shares. So we're buying low and buying more shares, and then the average cost of our shares over time is less by buying less when it's expensive, and by buying less when it's expensive and more when it's cheap. That is dollar cost averaging. I urge you, try not to try and think that you can outsmart the market. It's schizophrenic. We cannot. We don't know what it's going to do. And especially nowadays, we've got tweets going on left and right, and that will have a negative and a positive impact on the market, and we never know which one it's going to be. So just put your money in the market every single month on one day and let it ride. It's the best way to invest. So that describes Finance 101. I'm going to very briefly talk to you about the different investment buckets we can have. Oh dear, I think I overshot the mark. Let's just go back a couple slides. We're going to talk about IRAs, Roth IRAs, 401ks, and 403bs, and just about the tax differences between those. So for those of you that have an IRA, a traditional IRA, or a 401k that's a pre-tax account, those are monies that you've put in pre-tax. You've never paid taxes on it. You're not going to pay tax on the money as it grows, but all the growth is what we call tax deferred. So when you take the money out of those accounts, you're going to pay income tax on everything you take out. So if you believe that tax rates are going to go down for you at retirement, then we can make an argument that putting away money pre-tax is a smart thing to do. So you put away money pre-tax, you don't pay the taxes now, you're in a lower tax bracket. When you retire, you pay less taxes. On the other hand, there's something called a Roth IRA, or in some employers will offer what's called a Roth 401k. That is money that you put in after tax. You don't pay taxes as it grows, and all the growth is tax-free. So at retirement, you get that money out and you don't pay any taxes on any of the growth, and you've already paid taxes on the principal, so it's completely tax-free. If you are of the belief that tax rates aren't going to go down for you at retirement, then we can make the argument that it's probably better for you to do a Roth 401k or a Roth IRA. I'm a huge fan of Roth IRAs. I think that most young people should absolutely have a Roth IRA. So if your employer offers a 401k and doesn't offer the Roth option, do your 401k. You should always do a 401k if the employer is offering a match. You never want to leave money on the table. So if your employer is offering a match and you're not doing a 401k, that needs to be high on your list of, I'm going to do my 401k ASAP, because you're leaving money, free money on the table. But if they don't offer a Roth 401k and you're young and you want a Roth option, do the match in your 401k and then open up an individual Roth IRA outside of your employer and put money into that. If you're under age 50, you can put in $6,000 a year. If you're 50 and over, the maximum is $7,000 a person for your Roth. In the 401k, the limits are much, much higher. So it does, for those people who want to defer up to $25,000, if you're over age 50, you can do that in the 401k, $19,000 if you're under 50. So really utilize your employer-sponsored plans and just know the difference between your pre-tax and your after-tax accounts. All right, so tax deferral can give you a lot of power, but remember in this slide that I'm showing you, when you retire, you've grown that pot of money because you haven't paid taxes on it. But if you're in a high tax bracket, you're going to pay taxes on all of that money, which at the end of the day will work out pretty similar to the Roth. So very often, depending on your tax bracket, it makes more sense to put money away after tax. But that's the reason why you want to meet with your financial person and go over your tax advantages, your tax brackets, and which one makes the most sense. I would say doing one or the other is better than doing nothing. So even if you are in a Roth and maybe should be in pre-tax, or you're in pre-tax and should be in a Roth, you're still ahead of the game by doing something. All right, so let's talk about retirement planning briefly. Most people, there's myths that, you know, we retire at 65 and we never work again. That's not true. 40% of men and women over the age of 65 are back working part-time for one reason or another. Sometimes it's not always financial. Sometimes it's they retired and now they can't spend that much time at home with their spouse, so they have to go back to work. Social Security is really, unfortunately, a large portion of most people's retirement plans, and it's not enough. So if you're relying on Social Security, I would say don't really start saving on your own in your 401ks, 403bs, IRAs, so that you don't run out of money. Because the number one reason that people come in and say their biggest concern is running out of money in retirement. And you don't want to live that what if life in retirement. What ends up happening is you're scared you're going to run out of money, so you don't spend in retirement, and you go, well, what if this happens, so I better not spend, and what if that happens? So what ends up happening is you save all this money, you don't spend it, you die earlier than you would have liked, your kids inherit all the money, and guess what? They'll end up going to buy the boat, travel, do all the things that you said you were going to do in retirement. So you want to be able to save money, know that you're not going to run out, not worry about what if, and enjoy those golden years. We've talked about 401k, we've talked about pre-tax and after-tax, so I'm going to skip ahead because we're running close to the end of time. I want to leave a good 10-15 minutes for questions. I've talked about the Roth IRA, why I love a Roth IRA. The other thing about a Roth IRA is it can behave as an education fund. So if people, my clients, want to do a 529 college savings plan and they're not doing a Roth, I really encourage them to do the Roth first, because you can always take money out of a Roth to use for education with no penalties or no taxes. So consider a Roth before you consider a 529 college savings plan. Persistence is going to pay off. If you put away $1,000 a year and you get a 5 or 7 or a 10% rate of return, I would look at more the 7%. That's a realistic, moderate, aggressive rate of return. You can see after 30 years, $1,000 annual investment is $101,000. So just putting a little bit away is going to pay off. How to get started? Look at your current picture, write your goals down, start to have a way to get rid of that debt, pay yourself first, have an emergency fund, work with a financial professional who can help guide you and help you ride this journey together. Do reviews every month, every year, sit down, take a look at your goals, take a look at your accounts, and see if you can fine tune your strategy. That way you are sure to have success. So I've raced through a lot of material in a very short period of time. I hope you found this useful. Feel free to share all your questions. Jean, did you have any questions pop up? I haven't been looking at the chat box.
No, no questions.
No questions. Wow. Okay. Well, feel free to, Jean, is there a way that they can maybe reach out to us if they do have any questions? Jessica, can we share our information? How do you want to work this? If there are questions that pop up after the fact, we'd be happy to answer any emails or questions they have down the road.
Yeah, absolutely. If you're comfortable with that, I'd be happy to share your contact information. We will be sending out a follow-up with the slides and the presentation recording, so I would be happy to include that as well.
Perfect. All right.
Yeah, feel free to give both of our emails, Jessica. That'd be fine.
Sounds great. Well, thank you both for your time today and for everyone who attended. We really appreciate it and hope you guys found a lot of value.
Great. Thank you, everybody. Appreciate the time. Go start saving.
Thanks
you.
Glynnis. Take care.
Mm-hmm.
All right. Bye now.